This video, entitled 11 Types of Construction Insurance and Bonds. It examines the insurances and bonds that are commonly required in bid documents. Emphasis is placed on the importance of seeking professional assistance to thoroughly evaluate the scope of coverage in order to obtain an accurate quote. These coverages may vary from one project to another, depending on the requirements and specifications set forth in each bid document. Insurance and bonding play an important role in the bidding process by protecting the parties during the development of the work and its warranty periods. What this video is about. In this video, we will take you step by step through the 11 types of insurance and bonds that are commonly required in the construction industry and provide recommendations on how to quote them. Types of construction insurance and bonds. The tender documents must specify the type of insurance required by the contracting authority, the cover, and the sums insured. The type of insurance to be included in the tender is divided into insurance policies and guarantees which are necessary for the performance of the contract. The following table shows the different types of insurance commonly used in the construction industry. This screen displays a table summarizing the 11 types of construction insurance and bonds that are typically required for bidding. These insurances and bonds are identified by an arrow. Evaluate insurance costs. Insurance cost estimation steps to follow. Confirmation of which insurance companies will be acceptable to the customer. In most cases, the buyer will list the approved insurers in the tender documents. If this information is not included in the tender documents, we will need to send a written request to the client asking which ones are accepted. The second step to be taken is to request quotations from the authorized insurance companies in order to select the most suitable one. In order to choose the insurance company, it is necessary to evaluate not only the cost of the insurance, but also that its coverage includes all the risks to be covered. The advice of a risk manager and/or insurance consultant is advisable for this purpose. Calculate cost of police offer warranty. Bid bond. Purpose: bid bonds are intended to assure the bidding entity, which may be a client, government, or organization, that bidders are committed to and will maintain their bids. This guarantee penalizes unjustified withdrawal of a bid. Validity. The bid bond usually has a specific period of validity set by the purchaser. During this period, the bidder is obliged to comply with the terms of his bid. Once this specific period has expired, the bid bond is no longer valid. Evaluate insurance costs. Workplace accident coverage. Workers' compensation coverage. Workers' compensation is a type of insurance that provides financial protection to employees who are injured or become ill on the job. Disability benefits. In cases where the work-related injury or illness results in permanent disability or impairment, workers' compensation may provide additional disability benefits to compensate for loss of earning capacity. Workers' compensation is considered a no-fault system, meaning that workers are entitled to benefits regardless of who was at fault for the accident. Evaluate insurance costs. Life insurance. Employee life insurance. Employee life insurance, also known as group life insurance, is a type of life insurance coverage that employers provide to their employees. Coverage. Employee life insurance provides a death benefit to designated beneficiaries if the insured employee dies during the period of coverage. Group coverage. The employer negotiates a group life insurance policy with an insurance provider, and all eligible employees are automatically covered under the policy. Portability and conversion. Depending on the terms of the policy, employees may have the option to continue their life insurance coverage if they leave the company. Benefit amount. The amount of coverage provided by a group life insurance policy is typically a multiple of the employee's salary, equal to 1 or 2 times the employee's annual salary. Evaluate insurance costs. Civil responsibility. Construction civil liability refers to the legal obligation of construction professionals or entities to compensate third parties for damage, injury, or loss caused by their construction activities. Duty of care. Construction. Professionals have a duty of care to ensure that their actions do not cause harm to others. They are expected to follow accepted industry standards, exercise reasonable skill and care, and comply with relevant building codes, regulations, and safety guidelines. Negligence. If a construction professional fails to meet the expected standard of care, resulting in damage or injury, he or she may be held liable for negligence. Negligence occurs when the duty of care is breached, causing foreseeable harm to others. Evaluate insurance costs. Professional liability insurance, known as errors and omissions insurance, it protects professionals from financial loss resulting from claims of negligence or malpractice. It is designed to provide coverage for professionals who provide advice, services, or expertise to clients. Coverage. Professional liability insurance protects professionals against claims brought by clients or third parties alleging errors, omissions, negligence, professional malpractice, or failure to perform as promised. It typically includes legal defense, settlement, and judgment costs associated with such claims. Professions covered: accountants, consultants, architects, engineers, real estate agents, etc. Exclusions. Common exclusions include claims for intentional torts, criminal acts, bodily injury or property damage, covered by general liability insurance, and claims related to other types of insurance, such as workers' compensation. Evaluate insurance costs. Contractor pollution liability, also known as CPL. This insurance protects contractors and subcontractors against liabilities arising from pollution-related risks and incidents. Coverage. This insurance provides protection for contractors in the event of pollution-related incidents, such as accidental spills, environmental damage, or contamination caused by their operations. It covers both sudden and gradual pollution incidents. It can also provide coverage for third-party bodily injury, property damage, and cleanup costs resulting from pollution incidents. Covered parties. CPL insurance is typically purchased by contractors and subcontractors involved in construction, renovation, or remediation projects. Exclusions. CPL policies may have certain exclusions, such as intentional contamination, known contamination conditions, and certain types of professional services. Evaluate insurance costs. Commercial auto insurance. This policy provides coverage for vehicles used for commercial purposes. Coverage. Commercial auto insurance generally provides coverage for liability, physical damage, and other specific risks associated with the use of business-related vehicles. Liability coverage. This protects your business if you or your employees cause injury or property damage to others while operating the vehicles for business purposes. Covers legal expenses, medical expenses, and repairs. Physical damage coverage includes both comprehensive and collision coverage. Comprehensive coverage protects against non-collision events such as theft, vandalism, fire, or natural disasters. Collision coverage protects against damage resulting from collisions with other vehicles or objects. Uninsured/underinsured motorist coverage covers you and your employees if you are involved in an accident. Evaluate insurance costs. Equipment insurance for contractors coverage. This insurance protects the contractor against damage, theft, or loss of his equipment and tools and applies to owned equipment, such as excavators, bulldozers, cranes, generators, power tools, and other machinery. Rented or leased equipment. Equipment in transit. Coverage may extend to equipment and tools while being transported to and from job sites. Equipment breakdown. This coverage can help cover the cost of repairing or replacing equipment in the event of a mechanical or electrical breakdown. Equipment insurance for contractors. Continued. Loss of income. If a covered loss causes a business interruption, this coverage can reimburse the contractor for lost income during the downtime. Accessories and attachments. Coverage can be extended to accessories and attachments that are essential to the operation of the insured equipment. It is important to note that contractor equipment insurance typically does not cover liabilities resulting from accidents or injuries caused by the equipment. For such liabilities, contractors generally need general liability or workers' compensation insurance. Evaluate insurance costs. Guarantee insurance to ensure compliance with the contract. This is a type of insurance designed to ensure compliance with the terms and conditions of a contract. It provides financial protection to the beneficiary of the contract if the contractor fails to fulfill its contractual obligations. Here's how bond insurance works. The contractor purchases a bond from an insurer or bonding company. The insurer evaluates the contractor's financial stability, track record, and ability to perform under the contract before issuing the bond. Bond terms. The insurance policy outlines the terms and conditions under which the insurance provider will reimburse the project owner if the contractor breaches the contract. If the contractor fails to perform its contractual obligations, such as failure to complete the project, poor workmanship, or financial default, the insurance company will reimburse the project owner. This helps ensure that the owner can complete the project or hire another contractor without incurring significant additional costs. Warranty insurance focuses on the contractor's performance and adherence to the terms of the contract. Evaluate insurance costs. Bond insurance to replace the withholding of repair funds. This type of insurance is often used on construction projects to replace the traditional practice of withholding funds from each certification as a repair fund. Here's how it works. The contractor purchases a bond from a surety company. The surety company evaluates the contractor's financial stability, track record, and ability to perform under the contract before issuing the insurance. Bond terms. The surety policy outlines the terms and conditions under which the surety company will provide financial compensation to the project owner if the contractor fails to perform its contractual obligations. This includes addressing any defects or problems that may arise during the warranty period. Evaluate insurance costs. Advance payment and/or collection bond policy. This policy is a type of insurance coverage that provides protection to companies or individuals who have advanced funds to the contractor. The policy protects the insured against the risk that the contractor will not pay the funds advanced. Ultimately, the party that advanced funds, called the beneficiary, seeks a guarantee from an insurance provider to protect its financial interests, default or non-payment. If the debtor defaults or fails to pay, the beneficiary may file a claim under the bond policy, indemnification by the insurance provider. If the claim is valid and within the terms of the policy, the insurance provider will reimburse the beneficiary for the advance or payment that was not repaid or collected. Evaluate insurance costs. What additional clauses does the client require? In general, the client requires that the insurance policies contain the following clauses. Clause waiving the insurer's right of subrogation against the client, known as a non-repetition clause. Clauses that prevent the insurer from modifying and/or canceling the insurance without prior notice to the client. It should be noted that the client periodically monitors the validity of each of the policies required in the contract document. They do this before paying for a certificate. This concludes the 11 types of construction insurance and bonds video. In the next video, number 5 in this series, we will discuss financial costs to consider contingency reserve. If you find these topics interesting, don't forget to subscribe. We hope to have your support in our next video.